Hi, welcome back. In this video, I'm going to talk about the relationship between stock market and elections. So how stock market react to the election results and election in general. In 2020, we are having US election. We'll also talk about a bit and what are the expectations from the stock market and how the stock market will move is something also is very important for many investors. Well, we can talk a bit about that, but first let's see actually historically how stock market has reacted to election results. As you can see, you have data since 1926 up until 1926 to 2020, and see the performance of $1 invested over these periods. As you can see, during the election, during the right after the election, there is some sort of a volatility, right? So the volatility is quite high just right after the election result is declared, and it's has been the trend since 1930. So it's nothing new. Probably you can see higher volatility in such times, but you can also see quite a lot of volatility in 1960s, 70s, even as early as 1935 and 1945. This was so volatile. And remember, back in 1930 or 40s, we didn't have internet, there was no social media, information was not moving that fast like it is now. So back then, the only source of information was the radio and the newspaper. Even televisions were not that popular. Hence, you could expect a difference in the way this market moves to these results. But what you see here is that even back then, market used to be quite volatile with respect to this information. Um, so, as I just said, there is high volatility. However, in the recent times, what we have seen is that there is a positive return in the election year. So, election year is when the election takes place, and during the election era, we have seen that historically, the return is not just volatile. If you take the standard deviation of all the returns in the last say 20 years, what you will find is that it's quite volatile, but most of the times it is the return is positive. For example, here we have taken data now since 1980 up until 2016, which is the last election for US, where Trump won, and that was quite unexpected, by the way, because everyone was expecting Clinton to win. But from 1980s, where Ronald Reagan and Carter actually for the election, and you can see the returns in the election was all most of the times positive, right? So in the last 35 years, we see that 1 2 3 4 5 6 7 8, that means 8 positive and negative, 1 2, only twice negative, right? That means the odds are like the odds of stock market moving up is 8 to 10. That's huge, actually. That's a clear pattern. If you take even more historical data, like even like until 1950, 1940, you'll also find this pattern that in the election year stock market, I don't know for what reason, actually move up. The returns are most of the times positive and sometimes significantly positive. We have some more charts to prove that. Here you see the presidential election years throughout the history and the returns that you expect. Now in the equity space, the or stock, you see the return is somewhere around 9%, um, if a new president is elected, um, and then 11% if all presidential election, I mean, including all presidential election, regardless of it's a new president or incumbent. If it is incumbent, it's 13%, 4%, and so in the current context, if Biden wins, then you could expect that the stock return will be slightly less compared to if Trump wins. Okay, But so today is the election result day. We don't know. It's a very closely fought context, and we do not know yet who is going to win. But if the incumbent president wins, then we expect the stock to go up more compared to what it would where it would go up if Biden wins, because Biden is new president, whereas Trump is incumbent. All right, but regardless, right, regardless of who wins, it's likely that the stock market is going to go up. But initial days will be volatile. We have seen that, right? The first few days of maybe a month for a month time, the until we have the new policies are rolled out by the new president or the incumbent president. It's a bit difficult to actually predict the market because it's quite volatile. But after that, it stabilizes a bit. Uh, all right, so here it's even better overview of actually how the stock market moves in the election year and prior to the election year. Prior to the election year, the market moves wonderfully well. But we have the graph comparison between the incumbent president uh, and whether the incumbent president has lost. But basically, incumbent party lost. That means a new president. So this is a new president, and here this one. So the blue bar is the new president and the dotted bar is the incumbent president. So before the election, you see there is high growth rate in the market and it slows down, but it still remains positive until the election time. But if the new president is going to win, then you see that before the election, you see a downward trend in the stock market, and this is like prior to the election day. Okay, like 6 months and the 3 months, 1 month. But what's interesting for us is to see what's ahead of us, right? Well, for the first few months, right? As I said, for the first month after the election result has been declared, you see that the stock market is not going to do well for the most part of the first first month. It is likely because whether it's a new president or an incumbent president, it is not very clear what policy he will or she will adopt. So that's something not very clear. So it's likely that people might have a very negative view on the government policies. But what happens afterwards, after the first month, is that it tends to go upward, and you see that here, right? It stabilizes initially for a month and then it goes up. The interesting thing is that if it is an incumbent president who wins and continues to be a president next time, you see the stock market is going up quite steeply compared to if it is a new president. So new president is this blue bar, right? It is no doubt positive, but definitely not that steep as if it is the incumbent president who is winning. So very interesting pattern, and very interesting for all the investors to know that if your president is incumbent and he's winning, it is likely that the stock market is going to do really, really well, especially in the first 1 year of his tenure. And this is quite long time data, so you cannot say that, okay, maybe this is not representative, this is not okay, this is just a couple of years of data, it's a small sample. No, the data used in this is from 1936 to up until 2017, so it includes data for over 80 years. So so we have a fairly large sample, hence we can rely on this particular chart. Okay. So today in the morning, because this is election day, and we're going to get the results likely in the afternoon, or probably by tomorrow morning. And what as expected, we see the some level of volatility already in the market when the market opened today. So as you see, CNBC has reported that Dow futures falls and election remains undecided, but Nasdaq future pop more than 1%. So it's volatile because it's investors confused about about the election results, market is not very clear, and you see some ups and downs initially for a few days, and then it stabilizes, but to the positive side. But as we saw in the last slide, if the incumbent president wins, then only you see a steep increase in the stock prices, at least for the first 1 year of his tenure. So this is already evident, by the way, in 2020 election. This is also in line with the efficient market hypothesis, which says that the information reflects in the stock prices. That's true. But whether you can predict that or not is a question. It's hotly debated within the academic circle. Well, people who have come up with this hypothesis, they argue that you simply cannot predict it because information is reflecting and it is available to all of us. Hence, but if you have the information, others will also have the information, same information, and then it balances out. So you cannot really make a profit out of it because you cannot predict it beforehand. Because stock market is about buying and selling, right? So for you to buy sell a stock, you have to find a buyer, and if both of you have the same information, but then in that case you are less likely to make a good profit out of it, or an extremely good profit out of it, given that the rationality is going to be more or less the same for both of you. But that's not always true, right? In the real world, information asymmetry is very important. Not everyone has the same level of information. Similarly, rationality, like every individual is rational, is again a bit questionable, right? And secondly, you have uh, short-term view of the market, and you have long-term, medium-term view of the market. So all that play big role. And yeah, again, I don't want to comment on this. What I want to say is that yes, such information reflect in the stock market, and that's what we are seeing, and what we have talked already is actually is just yeah, is a reflection of the fact that information is yeah, stock market is very sensitive to the election result or information coming from the election result. All right, so very important to know for investors is that you have to be careful about the election forecast, because last time around in 2016 everybody predicted Clinton to win, but turned out Trump winning the election by a significant margin, I would say. So if you bet based on the election forecast, you have to be very careful, because you might lose money, especially in the first few months, because that's when the market is quite volatile. It's also happening this time around in 2020, when everybody, all the media agency predicted that Biden will win, but it's likely that Trump will win. I'm not sure yet; it's not declared yet, but yeah, that's what it seems, at least for now. Hence, the forecasting models for election are not to be trusted always, especially if you are an investor and you are investing money based on this information. Thanks.